Okay, hello and welcome everyone. Now in today's session, we will attempt December 2022 exam question number 1, that's FONDIR company. It's a 50-mark question and we need to firstly read the information and then we can move forward. So I am reading the information. There are 3 exhibits and requirements. Let's start with exhibit number 1. Okay. This exhibit states FONDIR company based in USA. So based in USA means home currency dollar, is involved in the production and sale of high quality foods under its popular brand name called Deli Belly. Initially, its products were mainly aimed at the USA market, but increasingly the products are sold internationally to North and South America and Europe. Rapid growth has meant that FONDIR is expanding its production facilities and receiving its revenues in a variety of currencies. Okay. So information states FONDIR is based in USA, currency is dollar. It's involved in production and sale of high quality foods. Popular brand name is Deli Belly. Initially, products were aimed at USA market. So based in USA, sells to USA, but now products are sold to North America, South America, Europe. Rapid growth means revenue is being received in many currencies, because when you are selling to USA, North America, South America, Europe, so different currencies revenues are being coming. Like we sell our courses in many countries around the world, so we receive revenues in different currencies. FONDIR has developed a robust system to manage its operational risk, but so far it has not managed its financial risk from currency and interest rate fluctuations. FONDIR's board of directors on the whole is supportive of the opinion that companies' financial risk should be managed using derivative products, and companies' approach to risk management should be communicated to its main stakeholder groups, including shareholders, managers, lenders, and employees. So company has developed robust system to monitor or manage its operational risk. Company has managed a system to manage operational risk, but has not managed its financial risk from currency and interest rate fluctuations. It is managing its operational risk, but not managing its risk from currency and interest rate. Board is also supportive of the opinion that it should be managed. FONDIR's marketing director questioned whether these and other financial risks should be managed at all. He suggested that cost of managing such risks would outweigh the benefits derived from company's management of these risks, therefore would be disadvantageous for the company. Now, FONDIR's board of directors is supportive of the opinion that financial risk should be managed, but marketing director says they shouldn't be managed at all. He says cost of managing those risks would outweigh the benefits and would be disadvantageous. So board is supportive of managing financial risk of currencies and interest rates, but marketing director is saying no advantage of this. FONDIR's finance director argued that although many risks could be managed using derivatives, some risks were harder to manage. She gave the Italian market as an example, where direct competitors from France and Germany have successfully penetrated the Italian market. As a result, FONDIR has found that its revenue from Italian market has been falling. And finance director suggests that this is due to weakening of the euro, the Italian currency, against dollar. FD is of the opinion that this relative weakening of euro is likely to continue for some time and cannot be managed through the use of derivative instruments. You know this, that derivative instruments are forwards, options, futures, right? So finance director is saying correctly that many risks can be managed using derivatives, like futures, options can manage many risks. Some risks were harder to manage, and she gave an example of Italian market that the euro is falling. So obviously, this risk cannot be managed through futures, options, because if a country's currency is declining, this is a country's issue. You cannot manage it through your products. Okay. So the information is we are based in USA, selling to a wide variety of countries, and board wants to manage its financial risk. Okay. Marketing director says no use. Finance director says we can manage the risk through these products, but some risks cannot be managed. Okay. Second exhibit. FONDIR sells its products to companies and customers based in Lothal, a country based in Europe whose currency is Lothal lira. So FONDIR is based in USA, okay, and it's selling its products to companies and customers based in Lothal. Lothal is in Europe. Its currency is Lothal lira. Is expecting a receipt of Lothal lira 357 million in 4 months' time on 1st. Okay, so you can get the today's date. Okay, you can get the today's date. That it is expecting to receive 357 million Lotil in 4 months time on 1st May. So you can say today's date is 1st January, because expecting 357 million in 4 months on 1st May, that means today is 1st January. So 1st February, 1st March, 1st April, 1st May. Today is 1st January. Okay. It may be mentioned elsewhere in the question, but at the moment we can write today is 1 Jan and receiving money in 4 months on 1st May. So I got to know that today's date is 1st January. That's why we are receiving 357 million in 4 months time on 1st May. So 1st January is today, 1st February, 1st March, 1st April, 1st May. Although there are no exchange traded derivative products available for hedging the Lotil era, Fonder has access to 2 over-the-counter derivative products. The first is 4-month forward rate agreed today based on Lotil annual base rate of 6% plus 60 basis points and USA annual base rate of 3.3% less 30 basis points. Spot rate between Lotil and USA is LL84 per dollar. So Fonder has access to 2 derivative products because you are receiving 357 million in 4 months. So you have 2 derivative products. First is a 4-month forward rate based on Lotil base rate of 6% plus 60 basis points, USA base rate of 3.3% less 30 basis points. Spot rate is USA LL84 per dollar. Second is OTC dollar call or put option with an exercise price of LL84. Premium for call option is LL4 per dollar one, and for the put option is LL3 per dollar one. Okay. So first is forward rate. Second is call or put option. Exercise price is LL84. Premium for call option is LL4 per dollar. Put option is LL3. Call, put both are given, rather than making a table, which we used to give in the class, in which at the left side there was an exercise price, then premium for call and put was given. It's given directly in paragraph that exercise price is 84 and premium is 4 LL for call and 3 for put. Option premium is payable at the commencement of the option contract. Fonder would borrow the money needed for the premium using overdraft facility. Companies paid interest on overdrafts at a rate of 5.4%. So you will borrow money for the premium. Okay. Board wants to know the currency exposure of this receipt can be managed using 2 instruments above, and also whether it is possible to hedge this using alternative methods and not derivative instruments. Board also wants to know whether this can be managed using 2 instruments and some other methods are available or not. Okay. So this is just about receiving one receipt and forward rate and call put data is given. Last exhibit. Fonder will choose the more financially beneficial hedging instrument to hedge the cash receipt from Lotil. Obviously, it will use the more beneficial hedging instrument. There are 2 instruments of Fonder. You always will use more beneficial approach, more beneficial instrument. Once the cash has been received in 4 months time on 1st May and exchanged into dollar, it will be invested for a further 5 months before cash is needed elsewhere. Fonder's board want to know how interest rate futures can be used to hedge against an increase and decrease of 0.5% in base rate. Fonder can invest funds on a short-term basis at USA base rate, which is currently 3.3% less 30 basis points. So once the cash funds have been received on 1st May, it will be invested for a further 5 months before cash is needing elsewhere. So you will invest them further for 5 months. How interest rate futures can be used to hedge increase or decrease of 0.5%. You can invest funds at base rate 3.3 less 30 basis points. Following information is available for June futures. 3-month futures contract have a contract size of $500,000. June futures contract price of 96.1 is quoted in terms of basis points at 100 minus annual yield. In the calculations following can be assumed settlement of futures is at the end of the month. We all know that basis diminished to 0 at contract maturity. We all know that there is no basis risk. We all know that margin requirements can be ignored. We all know that. So this interest rate futures data is given. Board assert that dealing with futures can be expensive because of margin requirements. They also want to know what margins are, whether or not they are dealing with futures is expensive because of this. Okay, that's it for the information. First exhibit, where it is based, USA, selling to all countries. You are not managing financial risk. Board wants to manage. Marketing director says no need. FD says you can manage the risk, but some cannot be managed. Then there is a receipt in 4 months, and you're given forward data and options data. And in the last one, there is an interest rate futures data. Okay, let's see what's the requirement. Okay, now if we move further to the requirements, let's see. Explain the exposure FONDIR faces with respect to falling revenue from Italy and suggest how this exposure to be managed. Exposed means risk. Exposure means risk. So you first need to explain what risk FONDIR faces with respect to falling revenue from Italy and suggest how this risk could be managed. So exposure means risk. You need to tell two things: what risk FONDIR faces with respect to falling revenue, okay, and how this risk could be managed. Now, let me explain you the answer of this. Explain the risk FONDIR faces with respect to falling revenue and how this risk could be managed, okay? So explain risk FONDIR faces, okay? So we all know there are three types of risks, okay? Number one, translation risk. Transaction risk, economic risk, okay? Exposure means risk. So what risk FONDIR faces? Exposure means risk. What risk FONDIR faces with respect to revenue from Italy, how this risk would be managed. You can read the Italian thing as well. Revenue from Italian market has been falling. FD suggests this is due to weakening of euro against dollar. FD's opinion, this weakening euro is likely to continue for some time, cannot be managed through the use of derivative instruments, okay? So we need to tell what are the risks, explain the risk FONDIR faces with respect to falling revenue. So there are three types of risk: translation, transaction, economic. Could be either of these. Either company faces translation, transaction, economic, because there are three types of currency risk, okay? So explain the risk FONDIR faces. You can write there are three types of risk: translation risk, you can write the definition of that; transaction risk, you can write the definition of that; economic risk, you can write the definition of that. Repeating, you can write it because this is with you. So translation risk is the risk of losses when financial statements of a company are translated from one currency to another. Transaction risk on one transaction, either receipts or payments. Import, export. Import means payments and exports means receipts. So on one transaction, either receipts or payments. And economic risk on both receipts and payments. Okay, risk on both receipts and payments. Okay, so you can write the definition of them because it's a 6-mark requirement. We have to work around it. That explain risk it is facing. There are three types of risk: transaction, translation, economic. Translation risk when FS are converted from one currency to another. Transaction on one transaction, imports or export, receipts or payments, and economic on both receipts and payments. Since FONDIR is producing goods in USA dollar and selling them in European market, which is euro. So it faces risk of losses on both receipts and payments. So FONDIR is facing economic risk or exposure, okay, because both receipts payment. How it will face both receipts and payment risk? Okay, it is producing goods in USA, so that means the production cost will be in dollar. And you have seen when a company is based somewhere and selling goods somewhere, they sometimes bring parts, import parts from their home country. So this is import, okay, incurs a cost, okay, and selling in European markets. So this is an export for them. They need to receive money as well. So they are basically facing both receipts payment risk, because you have seen in investment appraisal as well, a company is based in USA selling goods in Europe, okay? So they need sometimes stuff from their home country. So this is imports, and selling in European markets, that means they're exporting as well. So they will receive money as well. So a company which is facing both imports, exports, receipts, payments, it's exposed to economic risk exposure. So when you were asked, explain the exposure FONDIR faces, so you can write there are three types of exposures: or risk, translation, transaction, economic, and then it is facing economic risk. How this risk could be managed? Okay, so risk can be managed through some hedging techniques like futures, options, swaps, forwards, okay? And you can briefly explain forwards, futures, options, swaps. I think this will give you a good 5-6 marks because you have done a very detailed answer. That risk which it is facing, so you explain properly the 3 types of risk, explain them. Don't just leave like this. You need to write the complete definition. What risk it is facing, since it is facing both receipts and payments, economic risk, and can be managed through hedging techniques, and explain the hedging techniques. That would be it. Okay, you can write, and then we will move to the next part. Let's move on to the next one. Prepare a report for the board of directors of FONDIR, which calculates amount receivable in dollar from Lothal in 4 months' time using forward rate and OTC option 7 marks. Calculates the interest in dollar of the cash flow from Lothal when futures contract are used to hedge the interest rate fluctuations of 0.5. Calculation should include number of contracts and gain and loss in futures market. So first one is of forward and option. Second is of interest rate futures. Then comment on the results obtained. B1, B2 addresses queries raised by board. And 4 discusses whether it would be beneficial to manage its financial risk and whether or not the company should communicate risk management approach to its stakeholders. Okay. So it's a report part. So we all know that requirement B is a report. So we need to start from date, subject, introduction. Okay, so prepare a report for board of directors. So it's to board of directors from, if nothing is mentioned, leave it. Date, don't write the date. Subject towards amounts receivable from options, futures, interest rate futures. Derivative products or hedging techniques. Okay. Introduction. This report, all requirements, calculates amount receivable in dollar from Lothal using forwards and futures. It then calculates interest return in dollar of cash flows from Lothal. Okay. It then comments on results in B1, B2, and it then discusses if it would be beneficial to manage its financial risk. Finally, it discusses if it would be beneficial for FONDIR to manage its financial risk and whether it should communicate risk management approach to stakeholders. Okay. If you want to write it separately, you can. Okay. Then I have told you that for each requirement, you should put a heading. If it's calculation, appendix, if it's discussion, just write the discussion there. Okay. Requirement 1. Amount receivable in dollar from Lothal company using futures. Then second requirement, interest return in dollar of cash flows from Lothal. Okay. Then the third one, comments on results of B1 and B2. And finally, the fourth one, whether it is beneficial to manage financial risk. Okay. This you should make as the report format. Okay. And once you make this as the report format, okay, from date, subject, introduction, this report, all requirements, then headings of each requirement, that start solving each requirement. If it's a calculation requirement, refer to appendix. It's a theory requirement, write it here. Like requirement 1, amount receivable in dollar from Lothal using forwards and futures. So this seems to be a calculation requirement. So this would be referred to an appendix. Okay, so we will write appendix 1 shows amount receivable from Lothal using forwards and futures. The amounts are found as this and this. We will fill out it respectively. Okay. So you need to copy this, then I will refer to appendix 1, solve this, then I will move towards this 2. Interest rate and return in dollars. This again seems to be a calculation requirement. I will write appendix 2 shows. Then this comments and whether it seems to be a discussion requirement, I will write it here. Okay. So first please copy and then I will tell you what to do further. Okay. Now we need to do appendix 1 from receivable from lot using forwards and futures. Okay. So amounts receivable in dollar from Lothel. So Lothel is receiving 357 million in 4 months. Okay. Let's start this. FONDIR will receive LL 357 million in 4 months, right? You need to show working number 1 of forward exchange contract and number 2 options. Let's do forward exchange contract. It's very simple. In forward exchange contract, you just multiply or divide with the forward rate. Okay. So 4-month forward rate, but spot rate is given, right? But forward rate is not given. So you can easily find the forward rate. The first is a 4-month forward rate based on Lothel base rate of 6% plus 60 basis points and USA annual base rate of 3.3% plus 30 basis points. 4-month forward rate is not given. In fact, the rates are given. Lothel base rate and USA base rate. So through parity theory, you can easily do that, right? Let's just apply the parity theory here. You can say that Lothel base rate is 6% plus 60 basis points. It's annual. So 6.6%, and USA base rate is 3.3% less 30 basis points, 3%. So 6.6% and 3% are the base rates. So Lothel annual rate is 6.6%. Lothel 4-month rate, because we need to find 4-month forward rate. So 4-month rate, 6.6% is annual. So 6.6 divided by 12 into 4 months, 2.2%. Okay. And USA annual rate, 3%. So USA 4-month rate, 3 divided by 12 into 4 months. Okay, 1%. Okay. So forward exchange contract first means you need to find 4-month forward rate. You can apply the parity theory concept. It's current spot rate. So what is the current spot rate? It's 84. So 84. What is this 84? It's LL per dollar. LL up, dollar down. So interest rates of LL will come up, the 6.6%, and dollar will come down. Okay. So 84 into 1 plus HC. So 1 plus LL rate, 2.2%, 0.022 over 1 plus HB, 1% dollar rate. Okay, so it's 84.98. And you apply the forward exchange contract. The receipts through forward exchange contracts would be how much you are getting? 357 million. Okay. So 357,000 divided by 4-month forward rate, because it's an indirect quote. You are in USA, it's coming in dollar. So C8, 4,200 is the expected receipts in dollar. Okay, $4,004 of 200 is through forward exchange contract. Please copy this. Okay, now we have to go towards options. Now we all know the formula of options, but first read it. Options exercise price is 84, right? And call option LL4 and premium for the put option is LL3. Call put premium is given. Option premium is payable at the commencement of option. Founder would borrow money needed from the premium. Company pays interest at 5.4% for premium. You need to borrow money. So it's call option as well as put option. Call option premium is per $1. Okay, and put option premium is per $1. So it's LL. Okay. Now first make the format of options in case of receipts. The options formula is expected receipts using exercise price in our currency plus unhedged amount minus premium payable. Okay. Now students have to be a bit smart in this, because if you are just a rote learner, I'm sorry, in every paper you will feel confused. Here also I received reply from many students that we got confused in the exam. Why, I will tell you, but just see, follow your normal class pattern which has been taught, that this is the formula for expected receipts. Expected receipts plus unhedged minus premium payable, follow the class methodology. Now you know you need to find these three things. And once you're able to find these three things, that would be it. Okay. So expected receipts. Now, please carefully pay attention. Expected receipts. The first thing. It's found as a number of contracts into contract size. Now, many people were telling me that in this question, the contract size is not given. You are right, actually. The contract size is not given. No contract size is given. There is given, but this is for futures. Okay, for options, contract size is not given. Don't worry, just follow the regular class methodology. Okay, contract size is not given, number of contracts and contract size, and how we will calculate it. Just break it up. Expected receipts. How do you get the number of contracts? Number of contracts is expected receipts in foreign currency using expected receipts in foreign currency divided by exercise price. Okay. Divided by contract size. This is the formula of number of contracts. Okay. Making it more comfortable for you. Expected receipts is expected receipts in foreign currency divided by exercise price. Divided by contract size. Okay. Multiply by contract size. See, this is the formula. Number of contracts is this. This is number of contracts. Okay. And multiply by this contract size is the same as this. Right. So you need to understand one thing. This contract size is in denominator and it gets multiplied by a contract size. So both will get cancelled. This contract size where my cursor is and this contract size will get cancelled. Expected receipts in foreign currency divided by exercise price. It's in numerator slash divided by contract size. It's in denominator. Multiply the contract size. So both this cursor will get this and this will get cancelled. So you will get expected receipts as expected receipts in foreign currency divided by the exercise price. Okay, because the contract size got cancelled. So your expected receipts are gonna be expected receipts in foreign currencies 357,000 LL divided by exercise prices 84 LL. Okay, so expected receipts is gonna be 357,000 divided by 84, 4250. Right? We got the first figure. Okay, then unhedged. See, people were struggling in the exam that we aren't given the contract size. Okay, without contract size also, at least try to put what is given. You will reach the solution yourself. Okay, now what is the formula of unhedged? Okay, I have taught you the formula of unhedged is expected receipts in foreign currency minus number of contracts into contract size into exercise price. Okay, now let's find this. Okay, so expected receipts in foreign currency. Again, people are worrying that contract size is not given. Don't worry, just carry it on. Expected receipts in foreign currency minus number of contracts into contract size will be the same, that this number of contracts into contract size you have already given. Number of contracts is expected receipts in foreign currency or exercise price into contract size into this contract size. So both of this got cancelled. This will make it expected receipts in foreign currency minus exercise expected receipt in foreign currency divided by exercise price. Okay, this number of contracts into contract size end up making this, right? Number of contracts, this multiplied by contract size, both get cancelled. This is the end result of this number of contracts into contract size. Expected receipts in foreign currency divided by exercise price. Into exercise price. This exercise price and this exercise price also get cancelled because this is coming in denominator. This is multiplying, both of that gets cancelled. This is expected receipts in foreign currency minus expected receipt in foreign currency. So this produce a nil answer. Expected receipts in foreign currency minus expected receipts in foreign currency, 357 minus 357 produce a nil answer. So unhedged is 0, right? It's just about mathematical stuff that contract size is not given. So what you are doing, it's expected receipts in foreign currency divided by exercise price divided by contract price. This is number of contracts formula into contract size, divide, multiply, get cancelled. Expected receipts in foreign currency divided by exercise price, you get expected receipts first thing. Unhedged is expected receipts in foreign currency minus number of contracts into contract size. You have already seen number of contracts into contract size gives you this. So expected receipts in foreign currency divided by exercise price into exercise price. Both of this got cancelled. Expected receipts in foreign currency minus expected receipts in foreign currency gives you 0. So without number of contracts, your two things are there. Just try to put what exactly these things are going for. Okay. And finally, the last thing is premium payable. If you want, I can do the premium working downstairs as well. No problem in that. Okay. What is the formula of premium payable? The formula of premium payable is number of contracts into contract size into premium amount. Okay. You have already seen this number of contracts into contract size, this portion. number of contracts into contract size. Gives you what expected receipts in foreign currency divided by exercise price. Okay, so this will get converted, because when you break it further, you will get the same answer I'm writing directly. Expected receipts in foreign currency divided by exercise price into premium amount. Okay. So this makes it expected receipts in foreign currency as 357 million divided by exercise price is 84, multiplied by the premium amount. Now, this is important, the premium amount, because you have to see the premium for call option is LL4, put option is LL3, whether you will take call or put, because contract size is not given, but premium is mentioned in LL. Premium is mentioned in LL. So you are receiving 357 million LL. Okay. So if you are receiving 3 million LL, okay, you have to sell LL. Okay. Had the contract been per LL, okay, had the contract been per LL, you would have simply done this, that you would have sold LL, because you're receiving 357 million LL, you would have sold LL. Selling LL means you would have taken put option, but he's giving you per $1. Per $1 means the contract is offered in dollars. Per $1 means you are saying that I will give you dollars at 300 PKR per dollar. So this is the dollar rate. PKR 300 is per dollar rate. That means it's giving you the dollar rate. If it says pound rate is 370 per pound one, so it's the pound rate. So if LL4 per $1, this is not LL rate. Per $1 means it's dollar rate. So LL 357 million receipt, you have to sell LL, take a put option for LL, but it's for dollar. So you need to take buying dollars. Selling LL means you're buying dollars. Take a call option. So premium would be 4. Okay. You will multiply it with 4. Okay. This will give you 357 divided by 84 into 4. Okay. 17. I'll make it 357,000. 17,000. This 17,000 is LL. Okay. Because you multiply with 4 LL, so it's LL. Premium has to be paid immediately. So convert it by spot rate. So spot rate is 17,000 LL, and convert it by 84 is the spot rate, as well as the exercise price, as well as the spot rate. Okay. So this makes $202. Okay. There's one, this has ended actually. Okay. But the thing is that FONDIR would borrow money needed for the premium using overdraft, and overdraft is 5.4%. So this premium, you don't have cash to pay this premium, you need to borrow. That means like money market hedging, I taught you in the classes, the overdraft cost must also be hit. Okay. So this 202 cost OD rate per annum is 5.4%. You need after 4 months. So for 4 months, is 5.4 divided by 12 into 4, 1.8%. That means since you have to pay this $202 premium by borrowing money, so 1.8% interest cost would be hit. So this premium will be $202 plus 1.8%. The correct premium cost will be 205.C366. Okay. Now, this was same as money market hedging, because in money market hedging, lead payment, you needed to borrow money, so your amount gets adjusted by interest cost. Okay. So the final answer for this receipts will be, now we have all three things: expected receipts in foreign currency, expected receipts in our currency is 4250, plus unhedged is 0, minus premium payable is 205.636. So the final answer of receipts is gonna be 4044.36. Okay, so you have the final answer of options as well, and you have the final answer of forwards as well. Okay, please copy this. You have done this considering contract size was not given. Everything in unhedged was net off. You need to understand this number of contracts into contract size. As solved it further, this remains expected receipts over exercise price. Unhedged was easy. Premium was number of contracts into contract size into premium. This calculation left us with expected receipts and foreign currency over exercise price into premium. So we took a call option, because in receipts we need to sell put option, but since it was per dollar, that means we took a call option. Okay, premium was converted into spot rate, so it's 202, but since we are borrowing, so our interest cost will also get hit. Okay, please copy this. Okay, now let's move to the next requirement. Next requirement is interest return in dollars. Oh, just a second, please. Let me recharge it. So in the main report, you can write as answers 4250, 4250, sorry, 4044 and 4200. 4044 and 4200. Okay. Now, interest return in dollar of cash flow is the second requirement. Okay, it's also a calculation requirement. So appendix 2. Shows interest return in dollar from Lothil which is found as. Now, if you go to the requirements, interest return in dollar of cash flows from Nautilus, where futures contract are used to hedge the interest rate fluctuations of 0.5%. Calculation into number of futures contract, gain loss on the futures. It's a 9-mark requirement of futures, but this is an interest rate requirement. Okay. Because it's clearly mentioned that FONDIR will choose more financially beneficial hedging instruments. So the beneficial financial hedging instrument has been proved to be as forward exchange contract, right? Because it's giving more. So this is the more beneficial one. So FONDIR will choose more financially beneficial hedging instrument from the cash flows from Lothil. Once the cash has been received in 4 months' time, that is $4,200. On first man exchange into dollars, it will be invested for further 5 months before cash is needed elsewhere. FONDIR's board wants to know how interest rate futures can be used to hedge an increase or decrease of 0.5%. Can invest funds on a short-term basis at 3.3% at 30 basis points. Futures contract of 500,000. June futures. That means today's 1st May, you are taking 30th June futures. So 2 extra months, right? May and June. 96.1 is the price and 100 minus percentage. Okay, so let's do the workings in appendix 2 of interest rate futures. So it will choose the more beneficial option. More beneficial option is a forward exchange contract. So $4,200 cash is received in 4 months. And now it will be invested for the 5 months. So let's just do interest rate futures working. So very simple working. First, I want you all to make the format of interest rate futures that has been taught in the classes. That first step is number of contracts. Okay. Then basis risk. Then unused basis. Then future closeout price in both cases. Okay. The first case is increased by 0.5%. And the second case is decreased by 0.5%. Okay. And then tick size, outcome of hedge. Okay. Then number 6, I will write outcome of hedge. Both cases. And finally, effective rate. Okay. So let's start this working. So I will first try to find out number of contracts. So the working of number of contracts is borrow deposit amount. It's 4,200,000 divided by contract size. So 500, 4,200 divided by 500. So 4,200 borrow deposit amount. This will be invested, right? It's saying it will be invested for 5 months. Once the cash has been received in 4 months' time and converted into dollar, we'll choose more beneficial option. That's 4,200 invested for 5 months. So borrow deposit on 4,200 divided by contract size is 500. I'm working in thousands. Into time period of borrowing deposit, it's 5 months divided by 3. Okay. So 4,200 divided by 500 into 5 divided by 3, it's 14 contracts, right? Contracts. Okay. Basis risk. Let's go towards the basis risk working. Basis risk working is spot minus LIBOR less futures price. Okay. So spot minus LIBOR. So spot is 100 minus LIBOR is 3.3. Okay. Minus futures price that is given. So futures price is 96.10. Okay. So 100 minus 3.3 minus 96.1. Okay. 0.6. Unused basis, it's the extra months. Basis risk 0.6 into extra months. So extra months are 2. 1st May is the receiving and investing date. You need to invest on 1st May. You are taking future of 30th June. So whole May, whole June, 2 extra months divided by total months from today. Today is 1st January, right? I told you before, today is 1st January at the start of the question. So 1st January, full February, full March, full April. Okay. And full May, full June, 30th June. Okay. So it's 6 months. So future closer price in both cases, LIBOR increase 0.5. And decrease 0.5%. Already made it. So spot minus LIBOR. So this is basically 3.5 now. 3 was the rate. 3.3 was the rate, sorry, 3.8. So 100 minus 3.8 because it's increased by 0.5, 96.2 less unused basis. So 96. And here decreased by 0.5, that means it's 2.8. So 100 minus LIBOR, it's now 2.8 because decreased by 0.5 minus 0.2, so 97. Okay, this makes it the figures as 96, 97. Okay, then there is a tick. So let's go towards the tick formula. So tick is basically, what do you say? It's contract size into 1/10,000 into 3/12. Contract size is 500,000. Okay, so it's 500,000 into 1/10,000, right? So it's 1/10,000 to 3/12. So ticks becomes, let me do it on the calculator. 500,000 into 1 divided by 10,000 to 3 divided by 12, 12.5. Okay, now outcome of the hedge in both cases. So let's do the working of both cases. First case we all know is increase by 0.5. And second is decrease by 0.5. Okay, so we will do the workings of both cases and then wrap it up by doing the working of effective interest rate, sorry. Right. So how to find the outcome of the hedge in both cases? Let me open the formula sheet. Okay, it's basically actual cost of borrowing or actual return on deposit. So you first need to write it as actual return on deposit. Okay, I have told you the formula of this actual return on deposit many times. It's basically the amount into interest rate into time period over 12. Okay, so amount is 4,200, right? Into interest rates. So if you talk about interest rates, it's increasing by 0.5. So this makes it 3.8. But you can invest at 30 basis points less. So you can invest at 3.3%, right? Getting this? 3.3 is the base rate. Okay. So if increasing by 0.5, it's 3.8, sorry, and you can invest at 30 basis points less, so it should be 3.5% into time period over 12. So you're investing for 5 months over 12. Okay, 61.25. Okay. And if you want to do it for the full value for 200,000, 61250, and here it's 4,200. If interest rates decrease by 0.5, so this makes it 3.3 less 0.5, 2.8, and you can invest at 30 basis points less, so it's 2.5% into 5 divided by 12. Okay, so make it 4,200,000. Okay, this is the actual cost of borrowing or actual return on deposit. Okay, amount into this, what do you say, rate of interest into time period over 12. Then there is add less gain or loss on futures. So we need to add less what? Gain loss on future. Okay, so this is calculated as told you before. Difference in futures contracts price future lock-in rate into spot into number of contracts into tick. Okay, so difference in futures contract price and future lock-in rate. So futures contract price is 96.1 and future lock-in rate in case of increase is 96. Okay, what is this? A gain or a loss? Okay, the strategy is buy now, sell later. Okay, the strategy in receipts is buy now, sell later. So gain or loss on futures is the difference between futures price and future lock-in rate. Okay, so futures price is 96.1, sorry, 96 and 96.1. Okay, because the futures price is 96.1 and future lock-in rate is 96 in case of increase. Okay, it's buy now, sell later. So buy at 96.1, sell at 96. It's a loss. It will be negative because loss will reduce the return. Buy now, sell later. Difference between futures price and future close price into spot 100 into number of contracts 14 into tick 12.5. Okay, this will make it 1750. Okay, and here difference between futures price and futures close price. Futures price is 96.1, but futures close price is 97 in case of decrease. Okay, buy now, sell later. Buy at 96.1, sell at 97. It's again will increase the return, so add it into spot into number of contracts into tick 15750. Okay, so this will make it the net return as 59,500. 59,500. Okay, both have to be same. And then in the last one, you get an effective interest rate. Okay, and how do you find the effective interest rates? It's very easy. Net cost or return. So net cost of or return of both cases, it's 59,500 over borrowed or deposit amount. So 59,500 divided by 4,200,000, the borrowed or deposit amount, into 12 divided by time period of borrowing 5, 3.4% is the effective rate. Okay, so you needed to solve this requirement in a tone which stated that calculate the interest return in dollar of cash flows when interest rates increase. Futures contractor used to get the interest rate of 0.5, should include number of contracts, gain loss on futures market. So interest return in dollars is appendix 2. You can write in this report that it is found to be $59,500. Okay, you can please copy this. Okay, now, so after dealing with these particular requirements of, what do you say, the you were preparing a report, and in that report, we were part one of the reports has been done, amounts receivable in dollar from local informants, forwards and options, and part two has been also done, interest return in dollars. Now there is a requirement of 9 marks and 9 marks, comment on results obtained in B1, B2, addresses queries raised by board with respect to alternative methods to hedge receipt and margin requirements, and the B4 discuss it would be beneficial for FONDIR to manage its financial risk, whether or not the company should communicate its risk management to shareholders. So B3 and B4 seem to be computational requirements, sorry, discussion requirements, I'm sorry. So you can write it in the main report. One is comments on results obtained in B1 and B2. So your whole report would be completed in a proper manner, because remember the report I made to from date, subject and introduction. In that report, I specifically made requirements each head. So B1 was calculation appendix 1 on spreadsheet, B2 was calculation appendix 2 on spreadsheet. Now it's a discussion requirement, comments on results obtained, so we will write it. Okay. So obviously we will comment on the results results obtained in B1 and B2. So we will write in B1 the results of receipt was calculated using forwards and futures, sorry, options. The amount was $4,200. What was the other one? $4044 or 4043, indicating forward exchange contract as more superior than options. Okay. Then the same thing. This is because options involve premiums that need to be paid. Okay. So comment on the results obtained in B1 and B2. Similarly, in B2, the interest returns in dollar was calculated through futures contract and amount was $59,500. This amount was calculated in case interest rates increase or decrease by 0.5% and hence provide a shield against interest rate fluctuations. Okay. You have comment on the results obtained in B1, B2. Now address the queries raised by board with respect to alternative methods to hedging and margin requirements. So let's see, what is this? So the board is saying board is supported of the opinion companies risk should be managed using derivative products. Okay. And here also the board is saying how interest rate futures can be used to hedge against increase or decrease of 0.5%. So the requirement is address the queries raised by board with respect to alternative methods to hedge the receipt and margin. So it's hedge the receipt. Okay, it's not about interest rate futures, it's alternative methods to hedge the receipt. So you need to tell what are the alternative methods to hedge the receipt and margin requirements. Okay, so let's continue. The board is using derivatives to manage interest rate risk. So currency risk in case of receipt. They can use alternative methods like leading money market hedging to manage this risk. Okay. Now I'm not writing the definitions here, but you need to explain money market hedging and leading. Okay, because you have said that they are using alternative methods like leading money market hedging. So explain this. Okay, you know what a money market hedging process is, that in receipts we first borrow foreign currency. Okay, then because when you have stated that alternative methods are leading money market hedging, explain what is leading. It's early payment. Okay, and money market hedging, we first borrow from the foreign bank, then sell it to the money changer, then deposit the amount in local banks. So you need to explain this. Okay, and finally, after alternative methods, the requirement had one more part, margin requirements. Okay, what is this margin requirement? Any derivative product involves some margin requirements, that is initial deposit when entering into a contract, so that if prices move against us, we have to the shortfall gets compensated you enter into a contract and suddenly the prices go against us and you face loss. So you might run away and back off. Therefore, every derivative contract has a margin or deposit requirement, that when you enter into a contract of derivative, you deposit some sum called margin. This happens in futures, options, anywhere. And if the prices go against us, okay, that is deducted from your margin. Okay. And if your margin is insufficient, you get a call that is called margin call. Okay. That deposit more funds, else the contract will be closed and you will be the one bearing loss. So this margin requirements usually makes the contracts expensive as well. So I always suggested you that these past papers are just for your favor and benefit. Okay, obviously, when we used to study the past papers, we had to do themselves, but tutor is doing this for you. But obviously, we cannot write the full answer here. So it's always better to get the points and then refer to the examiner answers for more and better understanding. Okay, you can copy these points, please. You can also explain margin that margin requirements also tend to tie up companies' cash, which may lead opportunity cost. Okay, now let's move towards the last requirement. Report part 4 discussed it would be beneficial for FONDIR to manage its risk and whether or not company should communicate its risk management approach to stakeholders. Okay, so it's B4. Okay, whether it would be beneficial to manage its financial risk and whether they should communicate risk management approach to stakeholders. Okay, so we need to tell whether it is beneficial for FONDIR to manage its financial risk. Okay, now where did this come from? Marketing director questioned whether these and risks should be managed at all. He suggests that costs of managing risk would outweigh the benefits derived from management of these risks and therefore would be disadvantages for company. So whether it would be beneficial to manage financial risk. Marketing director is of the view that financial risks need not to be managed as cost of managing these risks outweigh benefits. His view of short-sightedness. Although management of financial risk does incur cost. Risk management has a cost, like hedging is through forward exchange contract. You pay more for forward contracts. In futures, you pay more. In options, you pay premium. So risk management has cost, does incur cost. But benefits obtained are usually more in terms of protection of currency or interest rate movements. Similarly, risk management may increase future cash flows of the company. You can elaborate this, how future cash flows can be improved. How? Because if you manage risk, okay, and let's suppose currency rates go up or down, you still receive more money, okay, or the locked money. Risk management also results in unnecessary losses avoidance, increasing the future cash flows. Risk management also results in lower cost of capital. Okay, like when you go for funding towards bank or other areas, they always see if a company is managing risk, they offer a lower cost of capital. This is also an advantage of risk management. Risk management also reduces volatility, brings stability. Stakeholders also like those companies who are managing risks rather than just letting them go on. Okay, so basically whether FONDIR should manage its risk, you need to give some advantage of the risk management. So I've given you 4 to 5 advantages. Slight elaboration will give you 4 to 5 marks. Okay, that it increases future cash flows, reduces cost of capital, reduces volatility. Stakeholders feel more confident with those companies who are managing risk. So these are all benefits of risk management. So FONDIR should manage its risk. Okay, and the last thing, whether risk management approach should be communicated to shareholders. Okay, this was the last requirement, whether company should communicate risk management approach to its stakeholders. If risk management approach is communicated to stakeholders, it creates a good image for the company. Stakeholders like investing in companies about whom they have information, and also it assurance to stakeholders that company is interested in protecting their interests. Okay. However, it must be ensured that too much information is not provided, which reduces competitive edge. Like to communicate, you give so much information that the information gets leaked. Many stakeholders know, competitors get to know, they apply that, and your competitive advantage gets reduced. So it is important and beneficial to communicate this to shareholders, but it must be taken that too much information is not provided. Okay, hope this is clear to you. You can copy